Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 28th, 5:34 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, mild correction. Check the trend gauge over here. Last week, we downgraded market leadership to bearish. They've held up pretty well this week, and that's some of the green shoots that we'll talk about in tonight's video. Short term and medium term, all five of the major indexes are trending below their downtrending short term and medium term moving averages. Short term being the 21-day exponential, medium term being the 50-day simple. That the market's ugly relative to that. We limit our exposure to the market when those are trending lower and the indexes are below there. It's a long shot for growth stocks to make significant progress with those wins in the face of the market. Long term, mixed bag. Small caps and mid caps firmly below their 200-day moving average. Dow broke below 2 days ago. NASDAQ 100 and S&P 500 holding above their 200-day moving average, and actually undercut and reclaimed the 150-day moving average yesterday and followed through a little bit there. And we've also seen relative strength on small and mid caps over the last 2 days. In particular, if you look closely, there's been subtle outperformance going into late last week. Also, that's another one of those green shoots I'm talking about. So we're seeing a couple of things that are positive, but really all that means for the moment is that the oversold market has stopped going down. We're a long way from doing any kind of victory dance, quite obviously. So what happened today? Gap down in the morning, thinking, more of the same after yesterday's positive reversal off the lows. But we didn't make much progress to the downside. And then late morning, we had a pretty strong rally higher. By the end of the day, this put in a three candle combination pattern known as a morning star, which is a bottoming pattern. And you can see that we'll take a look at it momentarily here, but you can see it on the three big cap indexes, the NASDAQ 100, the S&P 500, and the Dow. Small caps and mid caps actually look better, not a morning star. They actually exceeded that yesterday and made higher highs. That's some of the relative strength that I mentioned. And it's a good sign to see that, because the weakness in the mid and small are why the highs and lows have been so out of whack. Also, yields initially gapped up this morning, but came lower as the day went along. So we've got a 2 of the 3 candle combination for an evening star, which is a bearish pattern for yields, but that would be a corresponding bullish pattern for TLT and BND, and that would be a benefit to the markets. Again, may just be that we got stretched too far to one side and we're having reversion to the mean, but we got to stop going down or up in yields in order for the trend to change. So that's something we're looking for. And the dollar was down today also. So stocks had quite a few things going for them today, and that they responded. That's why we finished green. So we'll start off with the Revere Growth 8, our 8 ETF composite, up 1.03%, outperforming there. That's good. S&P gap down 0.15. As I said, didn't go any lower than that, or not much lower anyway, and then ended up up by 0.6 by the end of the day. NASDAQ 100, 0.3% gap down, positive reversal up 0.8%. Dow Jones Industrial Average opened flat, finished up 0.35%. Mid caps led the way up 1.05%. Russell 2000 actually opened positive, so some relative strength right off the bat there, and finished up 0.87%. Global Diversified 60/40 Stock Bond up 0.40%. Mostly stocks there. Bonds, as I said, reversed, but not enough to make much of a difference. In-house GROTECTION up 0.39%, kind of in line with the way we plan on playing this market. as it sorts itself out and tries to put in a bottom. We're not plunging into leaders, although I do have 10 stocks of interest that would be close to buy points if we would get the follow through day. Today was O'Neill rally attempt day 2. Ideally, we look for day 4 through 7 to have a follow through day. Day 4 would be Monday. Let's dive right into it. We'll start off with the S&P 500, not the Nasdaq 100, but they look pretty much the same. Here's the S&P 500. Here's that 3 candle combination that I was talking about. Basically, it's when you're in a downtrend and then you stopped going down, reverse back to the upside, and then see follow through to the upside on day 3. So this is day 1, last day down. Day 2, we were going further down, but we stopped and reversed. Day 3, followed up to the with strength to the upside. 3 candle bottoming combination called a morning star. And if we're going to look at bonds here, it's just the opposite. It's called an evening star, which is a strong pattern up, one more that reverses, and then a follow through to the downside to cement the 3 candle combo. Haven't made it to the ADMA yet. If the 150-day was on here, you'd see the undercut and reversal and follow back through to the upside. Let's go to the NASDAQ 100, which actually did climb up into its ADMA, and that's where today's rally was capped. Need to get above that level. That's the first step. Our ultra short term exponential moving average, the 8-day. So a move above today's high and above that ADMA would be good for the bulls. Then we look to close the gap from 920 when we gap down on 921. That's the next target. And then we'll run into the declining 21-day moving average and we'll see what happens there. But let's go back to the S&P. This looks a lot like the August 18, 19, 21 combination 3 candle combo. So here we're in a downtrend, going lower. This is candle 1. Candle 2 continued lower but reversed up. Candle 3 followed back to the upside. We rallied up for 3 days, then had a negative reversal, and then some strength came in. So notice we never broke below the 3rd candle in that 3 candle combo. And then we put in a little bit of a rally before topping and rolling over again. So uh, the point of this 3 candle combo is to say that we've put in a short-term bottom, and quite obviously a break below today's low would be bad. A break below the low of Wednesday would be extremely bad, because we've highlighted a couple reasons why that was a natural spot to bounce, getting back to the gap of the 6-1 upside, getting back to down to the 150-day moving average and recovering it. So for now, some areas that should have acted as support did. We had some follow through to the upside today, but again, we're far from out of the woods. This is just the first step of getting out of the woods. Or getting to the edge of the woods. How about that? Or getting to where the edge of the woods is in sight. Let's say that. Dow Jones Industrial Average, there's your 3 candle combo also, but today's high was rejected at the flat 200-day moving average. Still a 3 candle combo, and again, it's a bottoming pattern, and it's the first step of steps in the right direction. Now, mid caps, uh, we never really undercut, so we didn't have that 2nd candle in the 3 candle combo. And if you look closely, that's where the relative strength comes in that I was talking about. And for the last 2 days, mid caps and small caps have been the 2 outperforming indexes. So you can see where the top of the relative strength line is now. Go back to where it was prior when it was at that level, and where was price when it was at that level, all the way up here. So this means on a relative basis, we're making new highs before we're making the equivalent new highs in price. This is probably the thing that is the biggest positive that I'm seeing out there. Finally, we get some relative strength out of mid caps and small caps, and again, this affects the new highs, new lows, the breadth, obviously. And the same thing shows up on small caps. You can very clearly see the relative strength over the last 2 days there. And again, not really the three candle combo because we never made a lower low on the second day. Uh, Intraday, we got back above the declining 80 MA, but failed there. So again, not all roses. We stopped at really the first time you come back into a moving average like that, it's normal to pause. Ideally, we would see some sort of tight sideways action tomorrow, but we do have PCE inflation data before the open that will cause some volatility. But ideally, you go sideways, and then day four next week, we'll try to make an attempt at that 180 level and the declining 21 EMA. So really, all five of the indexes looking to accomplish the same thing: get above the 8, fill the gap, attack the 21. And we'll see what happens. Tomorrow's day three, assuming we hold the bottom of holding Wednesday's bottom, and then day four starts the optimal window for an O'Neill follow through day. And as I said, I'm going to go through 10 stocks here that are very close to low risk entry points and would give, let's just say there would be merchandise to buy, in my opinion, if we would get the market wins at our back instead of in our face. Let's flip over to the VIX. So the VIX yesterday got above that 19 level and reversed. Got above it the day before too and reversed, so didn't quite close above, but now back below the declining 200-day moving average coming into the 80 MA. So this is again a step in the right direction. The VIX is agreeing with what the market's doing, coming off the highs as the market comes off of its lows. Really, what we want to do is see this get back closer to this 15 level, back below the 21 and the 50-day moving average, and into this area down here where volatility is reduced, and this is where the markets have had their best performance this year. Let's go to the dollar. We got some benefit from the dollar today. As you can see, there's your three candle combo. In fact, it's close. You're supposed to go halfway into the candle of the day one, but look for some more follow through uh, tomorrow. But basically, opposite of what we see for the bottoming pattern. See, you got an uptrend. The middle candle is the uptrend stops, and you start coming back a little bit. We didn't come back much yesterday, and then gap down today and close at the low. So it's a not quite a formal morning star, but it's kind of trying to form it. So dollar weakness today, that definitely benefited stocks. How did it impact precious metals? Well, it didn't. Well, at least they came off their lows, or gold did anyway, and closed in the top of its range, but it made a lower low. Gold down 0.5%. Gold stocks uh, turned positive by the end of the day. So that's the second candle of the three candle combo, up 0.5%. And SLV, silver, up barely, outside positive reversal there for silver. So gold didn't benefit, but two out of three ain't bad, as Meatloaf once sang. Bitcoin and Bitcoin stocks had a good day. You can see Bitcoin up 3.6% here, coming into this 14 level and declining 50-day moving average. Let's flip over to bonds now because things started out rough with bonds, which corresponded to the gap down that we had. Bonds lower means yields higher, but we put in the bottom pretty quickly. And then BND started rallying, and with price going higher, this means yields are coming down. Closed at the high of the day, did BND. And again, we were pretty extended to the downside here on this. So this is the second candle of the three candle combo. Normally, you don't penetrate the first candle into the depth that this one did. There actually might be a different name for this one, but it is a bullish setup. TLT, same thing, putting in a bottom, closing at the high of the day. Now let's flip over to yields. You know, we'll see the yields initially pop and then come off. which they did make a higher high, close at the lows of the day. That's TNX, the 10-year, TYX, the 30-year, gap up, close near the lows of the day. So this is what we needed to start happening in order for stocks to put in a bottom. And note that we got it last week, and it was just one day, and it was just a one-day event, and then we had a bad Monday, Tuesday, Wednesday as far as rates went. But again, situation like back here in mid-August, which I mentioned that date earlier, and it's just the opposite on the yields as what we're seeing when the index is bottomed on 818, 819, and 821. So that's the inter-asset correlation. Let's go to the tail of the tape. I got some things highlighted in green here, and those are beneficial to stocks also. So all of the stochastic indicators for the five major indexes are oversold, but they hooked up today. Same thing for all 8 of the RG8. They're in oversold territory, but they hooked up. US dollars overbought, the stochastic hooked down, so that's in green, that's a benefit. And then rates at a new high, but then a reverse lower, so that's beneficial to stocks also. Add on that the AAII bullish percentage fell all the way to 27.8. That's the lowest since we put in a bottom last time, and bears jumped up to 40.9. So bulls came off another 4 points, bears went up 6 points. This is headed in the right direction that you would want from a sentiment standpoint, not with an exclamation point. We were all the way up in 60 for the bulls after the last extreme sell-off. This sell-off, hasn't, they didn't even get to the 200-day moving average, but it's let's just say that the sentiment has gone in the right direction, with bulls coming lower. We were over 40 on bulls just 3-4 weeks ago, and now bears are above 40. So this has gone in the right direction. Some news. PCE inflation data tomorrow morning, as I mentioned, potential October 1 government shutdown. There were a few economic numbers that came out before the open that caused some volatility and probably impacted the volatility of rates and stocks also. But again, we'll look for follow through tomorrow as the PCE inflation data is the most important inflation or the most important data point released this week. Day count from day 1 to day 2, 10 days below the ADMA and the 21 EMA. That's on the long side for ADMA, but as I mentioned last night, I did see a 17-day below the ADMA last time we were selling off significantly. Another jump up into the support resistance 4,300 level, still between support and resistance here on the NASDAQ 100. 10 out of 11 spider sectors were up today, including coal, semiconductors. This is one that really got my attention. That's a big sector that needs to bottom if tech stocks are going to do anything. Bitcoin and Bitcoin complex also strong. ITB builders making a bounce, and here's the, with the rates, this is the reversal, just the same as yesterday. We started in one direction, ended by the other by the close. On the downside, only utilities and the dollar. No changes in the portfolio, 0.070. The adjusted beta, bottom line for the day, gap down, but a late morning rally put in a morning star in the big cap indexes. Small and mid cap relative strength continued. We saw the yields reverse the way we needed to. We saw the dollar reverse the way we needed to. We saw a hookup in the stochastic on the five major indexes and on the RG8. So it's a start. That's all we can say. We don't massively plunge off of one day. If we did a couple days ago when we had a one-day wonder, we'd have been regretting it. But we continue to have our 60% allocation to S&P 500. We also own energy, NRGU, and CCJ, and let's take a look at a couple of those now. NRGU, energy kind of volatile today. I would be I'd be okay with getting out of this at break even because energy prices coming off will take some of the pressure off of inflation data. We got in here at 5:15 we sell out at 515 for break even, I'd be okay with that. It would probably mean that strength is going into other sectors and hopefully including growth sectors. On the other hand, CCJ uranium, Mike's going to talk a little bit about this on the podcast tomorrow. Uh, there was a story this morning that Russia was not going to sell any uranium to the US, and this initially spiked all the uranium stocks and the uranium ETFs. Came off a little bit by the end of the day, but still up 2%. Those are the only two individual positions we own outside of the SSO, S&P 500 ETF, and then we still have for some taxable accounts Nvidia that we were planning on hedging if it broke below 400. Uh, it looks like it's trying to put in a bottom, but this bottom could very easily turn into a bear flag if we very quickly break back below that to the downside, and then we put the hedge on for the taxable accounts that had significant gains from when we bought back here before the two prior um, earnings reports where we had the big gap up. So let's take a look at these 10 charts that I was talking about that are near decent entry points. Now, a lot of junk rallied today. In other words, things with recently lagging, a lot of them growth names, a lot of them high short interest. That's one of the first steps for a bottom is that the shorts start to cover. So you often see outperformance among junk names in one of the first couple days off the bottom. That's why O'Neill waited for the 4th through the 7th day off the bottom through the follow through day to get the short covering out of the way and to make sure that it's true buying in stocks and not just short covering. But and then some stocks that have been leading recently didn't have that good a day, and that's again normal to see that as long as we're not selling off on heavy volume or breaking significant support areas. Nutanix with a 2.3% pullback today. This is again, these are low risk entry points relative to the 21 where there'd be a quick stop out is the primary criteria for them. 6 of the 10 are off of the 21-21 list. 4 others were either on the 21 over 21 list last week and fell off and rebounded this week, or one of the big 7, and we'll get to that momentarily. So there's Nutanix. This is the second of the 21 over 21 ESTC. Again, a pullback today, slightly above average volume. That 80 level seems to be a resistance area. And again, you don't break out and make any progress on growth leaders in a bear market or when it's not a favorable condition for growth stocks. But you do see the gap up here in the follow through strength before the market really started to correct. This had gone up over the last couple of days while the market was coming back. So some severe relative strength there, just given a little bit of it back 2 of the last 3 days. This one's on our low risk buy list also. Dell, another one, had really outperformed since its earnings report, pulled back, bounced off of its 21-day moving average yesterday, tight inside day today on below average volume. Akamai, this is one that made new highs while the market was coming back. And you can see the gentle pullback and even showing relative strength during the pullback hanging around the ADMA. This is probably the best looking setup out there as far as it being a pure base, try to break out, come back to the pivot or into the base and the ADMA on below average volume. This is probably uh, ranked number 1. Note that earnings picks up next year, not this year, and it gives it a peg ratio looking forward to below 1. So that's Akamai, CEG, alternative energy. They're a utility that basically is carbon free. Uh, Initial strength while the market was pulling back. Look at the relative strength line there. So pullback's kind of normal and it's holding the 21 on the pullback. And CF, this is the 6th from the 21 over 21 list. This tried to break out, um, pulled back to the ADMA and bounced today. All these are showing relative strength. So there's another one. Now the other 4, we'll start off with the first of the big 7, or the only one of the big 7 that's in this list, and that's Meta. Meta had an investors day yesterday, and it initially sold off and then got bought up to close at the top of the range, followed through to the upside. You've got three moving averages all tied up here, right around this 300 level, up 2% today. I do notice the big selling bars here, but I also notice that this is showing some relative strength, which none of the other six members of the Big Seven are showing. So this one has our attention. That's Meta. So we got three left. These three were punted from the 21-21 list, but have reclaimed the 21 since then. You can see CrowdStrike. This was a good relative strength winner here, then flagging. Note the relative strength line is at new highs before the price is. That's always something that we look for. CrowdStrike back above the 21. VRT, this is one we got stopped out on with the break below the 21 last week. Made a nice move today above the 21, pulled back into the close. It's sitting right on the 8 and the 21. This is a pretty clear downtrend line here that it tried to get through today. Didn't quite do it, but it's certainly a pretty good setup, a low risk setup. And finally, APP. Trying to regain that 40 level, had the big selling bar last week as the market sell-off really started in earnest. But this was extremely strong since it's earnings day, and it's above the high volume close of that earnings day, sitting right on the 21 as it tried to recapture the 21 and the 8 today in this 40 level, which provided resistance there, resistance slash support there. Now it's acting as resistance. A big move above that 40 level would be a change in character and a possible buy point. So that's a 10 that we're keeping an eye on. And that's enough to wrap up the video. As always, like your feedback. If you're watching us on YouTube, please like and subscribe, and feel free to repost a link to the video. More people that find out our approach, that you don't have to be a slave to what's going on in the market, the better we think all investors will be. For feedback, email me, don@revereasset.com. If you're interested in becoming a client, my partner, Dan Stewart, dan@revereasset.com, or the phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. At Revere, our mission number one is to avoid these severe drawdowns. They all happen if you get below the 200-day moving average. We are not there on the big cap indexes, namely the S&P and the QQQ. That's where the focus of most of our studies have been. We certainly pay attention to the other three indexes too, but don't put as much weight on them as we do the NASDAQ 100 and the S&P 500. And we're right around the 7% off the high mark on this pullback. But now with a three candle combo, trying to put into a bottom. All bottoms, most bottoms are put in with a false breakdown, and that's what we saw yesterday, finishing at the high of the range and then following through on some strength today on the three big cap indexes. The mid and small actually showing relative strength against those big cap indexes the last 2 days, so that's another sign of strength. And we'll see what tomorrow brings us with the PCE data. And with that, I'm going to wrap up the video for Thursday, 9/28. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.